The presentation explores the journey of Jet Airways, from its inception in a newly liberalized market to ambitious expansion and eventual collapse. We analyze how shifts in the market dynamics, fuel price volatility, fleet decisions, and branding strategies affected its operations. The story of aviation in India began in 1932 when Tata Airlines, a private company, started commercial flights. It later became Air India and led the foundation of air travel in the country. However, in 1953, the government nationalized airlines, creating Indian Airlines and Air India. For nearly 40 years, state owned carriers dominated the sector, with little competition or innovation. This changed in early 1990s when India's economy opened up. Between 1991 and 1993, the Open Skies policy allowed the private players to enter the aviation market. Naresh Goyal took the opportunity and founded Jet Airways in 1992. It started operations in 1993 as a premium full service airline offering superior in flight experience and modern aircraft, quickly becoming one of the country's top carriers. But the industry soon faced a new challenge with the rise of low cost carriers, or LCCs. Unlike premium airlines, LCCs focus on cutting costs by operating with a single type of aircraft, offering only essential services and using quick turnarounds at the airport. They avoid unnecessary expenses like lounges or elaborate meals, which helps them keep fares low. Major LCCs like Air Deccan in 2003, SpiceJet in 2005, and Indigo in 2006 made flying affordable to a much larger population.
Now let's talk about market dynamics and competitiveness. These are the five forces. First, rivalry. Competition is extremely high in Indian aviation market. Airlines constantly cut fares to attract passengers, which often leads to price wars and very thin profit margin. Second, bias. Passengers in India are very price sensitive. Most of them check online travel agencies and compare prices before booking. This means that people don't stay loyal to airlines. They usually pick whichever is the cheapest. Third, suppliers, aircraft manufacturers like Boeing, Airbus, fuel providers, and skilled pilots have strong power over airlines. Fuels, especially, make a big portion of cost. So, whenever fuel prices rise, airlines struggles. For new entrants, starting a new airline is not easy. It requires huge investment in aircraft, infrastructure, approvals, but government schemes like Udan made entry somewhat easier by supporting smaller airlines. Fifth, substitute on short distance routes. Trains are act as a strong substitute since trains in India are cheaper and more accessible. Many passengers still prefer them over flights for shorter journeys. Now, if we look at market share, we see that how these forces played out in real life. In 2010, Jet Airways was the leader, while Indigo was much smaller. But by 2014, Indigo had overtaken the Jet Airways, and by 2018, it controlled more than 43% of the market. Meanwhile, Airways collapsed under pressure. Air India remained stagnant, and SpiceJet only managed a moderate share. So overall, the picture is very clear. Indigo low cost strategy allowed it to succeed in the market full of challenges, while many full services carriers struggle to adapt.
So let's see what differentiates Jet Airways and its unit economics. Jet's value proposition relied on a visibly better product and a dedicated and a loyal customer base. But premium product features such as multi-class cabins, lounges, catering, and higher staffing ratios raised the fixed cost and variable costs. Initially, Jet invested in single-type aircrafts, but they also introduced wide-body carriers to turn into a full-service carrier. The numbers show the problem. Let's first define what RPK is. It is the revenue passenger kilometer, which is the number of paying passengers multiplied by the distance flown in kilometers. Now, the profit Jet makes is given by yield times RPK. So as you see in the chart, which is generated after analyzing the data from website of Directorate General of Civil Aviation, Jet's revenue per RPK advantage from premium passengers was smaller than the expense penalty, which produced a negative unit margin. A negative spread means that the airline lost money on each seat flown. As you see during the years 2012 to 2014, Jet was in heavy losses. Continuing further, Jet Airways margins from 2009 to 2018 show a clear pattern of instability and occasional small profit, but deep losses in years like 2013, 2014, and 2018. As a full service carrier, its costs were 30 to 35% higher than low cost rivals such as Indigo. So even higher revenues couldn't close the gap. The cumulative profit trend, which is computed as the cumulative sum over the revenue minus expense multiplied by the revenue passenger kilometers, tells the bigger story. Short recoveries, but an overall decline. The brief uptick in 2016 and 17 came from low fuel prices, not real fixes in the company. And by 2018, fuel costs rised and pushed the airline back into steep losses. Unit economics on the right show that most of the fare goes into fuel, followed by aircraft maintenance and salaries. Note that Jet Airways never made their actual unit economics public, so this is an average data over all the airlines. Moreover, the analysis can be found on the GitHub link which is provided.
Now let's see the strategic missteps that led Jet Airways towards insolvency. In 2007, Jet Airways acquired Air Sara for $500 million, which was an overpriced deal that added heavy debt just before the 2008 financial crisis. Also, its rebranding to Jet Light failed to achieve true low cost efficiency. Sub-brand confusion further hurt the airline as managing Jet Airways, Jet Light and Jet Connect created fleet diversity, operational complexity and higher cost, thus diluting the brand. Additionally, poor fleet and financial decisions including mixed aircraft orders, costly leases and reliance on Etihad's equity infusion in 2014 only offered short-term relief without fixing core issues. Finally, in 2018-19, rising fuel prices, rupee depreciation, mounting debt, and aircraft repossessions forced Jet Airways to suspend operation on April 17, 2019. Now let's see what Jet Airways could have done differently. First, they should have prioritized financial discipline, avoiding overpriced deals like the Air Sara acquisition, maintaining larger cash reserves, and using short-term financing only for structural gaps, not expansions. Secondly, adopting a clear dual brand strategy would have helped, creating a separate low-cost barrier with its own fleet and management while keeping Jet Airways focused only on being a premium full-service airline like the Qantas Jetstar model. Third, the fleet simplification and network focus were vital, using standardized aircraft, cutting unprofitable routes, and prioritizing international trunk routes via hubs like Mumbai and Delhi could have improved efficiency. Lastly, product unbundling, charging separately for baggage, seat selection, and Wi Fi, along with stronger board oversight, transparent finances, and a time bound turnaround plan would have ensured long term sustainability.